Thank you for joining me. My name is Jonathan Wilson, and I am the co-founder and CEO of the FinCEN Report Company, and this is the FinCEN Report podcast. You've probably heard some of our podcasts in the past. We talk about FinCEN and the FinCEN real estate rule, and today I want to talk about the purposes behind the FinCEN real estate rule. In some of our past episodes, we've talked about the hows and the wherefores of the rule, how it's going to work, what real estate title attorneys need to do in order to prepare for it. But a lot of people have been asking, why is FinCEN doing this? Is this just another example of governmental overreach, or is there a good public policy behind the real estate rule? And I'm here to tell you that while we can debate how effective this will be, there is a good intention, a good public policy behind the FinCEN residential real estate rule, and that is the hope of clamping down on money laundering. Throughout history, people who study the topic say that money laundering is the life's blood of organized crime. You see it in all of the television shows we watch that feature some sort of criminal activity. Breaking Bad is a great example. It doesn't do any good for a criminal organization to generate cash through selling drugs or weapons or other contraband if the organization is not able to make that money appear as if it was legitimately earned so that they can then deposit it in a bank and spend it and do things with it. If you're like Walter White in Breaking Bad and you're standing in the desert with drums full of cash, you really don't have anything because you can't spend that money without throwing up a red flag because you're spending cash that you couldn't possibly have earned, in his case, as a high school chemistry teacher, right? So that's where money laundering comes in. How does money laundering work? Well, money laundering involves a process by which the criminal organization takes their illicit funds, their illegal money, they combine it with funds from a legitimate business activity. In the case of Breaking Bad, Walter White had his car wash, right? And he would inject cash into the car wash from his illegal drug activities, pay tax on the whole thing, and when it came out the back end, it looked as if he had just had a very profitable year at the car wash, and his proceeds that he'd pay taxes on were cash that he could deposit in the bank and spend. Now, it just so happened it didn't work for him. He made so much money through the illegal activities that it dwarfed what he made at the car wash, and he was never able to launder all the money, but you get the idea. That's what he was trying to do. Well, for years, FinCEN has been empowered under the Bank Secrecy Act with trying to stop money laundering. More than 2 decades ago, they initiated what they called the geographic targeting orders. And what they did is they required closing attorneys and title agents in specific jurisdictional areas, certain zip codes, to file a report every time they had a residential real estate closing above a certain dollar value. What they learned in that process is that illegal organizations, illicit organizations, have in fact been using residential real property as a means of laundering money. If you read FinCEN's release in the fall of 2024, they describe several different examples that they had prosecuted involving money laundering through residential real estate. In one case, there was a money launderer in the suburbs of St. Louis, Missouri, who was buying relatively inexpensive houses. The money launderer would take cash from illegal activities, a series of $9,000 cashier's checks. $9,000 is significant because it's below the $10,000 limit that would otherwise trigger a suspicious activity report. The money launderer shows up at closing with a bunch of $9,000 cashier's checks, buys the property, hangs onto it for a short while, then sells the property again, and now the proceeds of that sale appear to all outward eyes that it is a legitimate proceeds of a real estate transaction. The money launderer can then take that cash, deposit it in a bank, and do things with it and not worry that that deposit is going to look like something that should trigger an investigation. That's small dollar value crimes. There are also many examples that FinCEN recounts in its 2024 release of high dollar value transactions, real estate transactions that were worth many millions of dollars outside of New York City, Long Island, New York, and especially in Miami and Los Angeles. In those situations, you've got condominiums that are worth millions of dollars, and the money launderers are able to use illicit cash to fund those purchases and then flip the properties later, with the proceeds then appearing to be the legal proceeds of a transaction. Well, through the geographic targeting order regime, FinCEN was able to learn a lot of information, confirm its suspicions that real estate was being used to launder funds, and that really was the impetus behind the FinCEN residential real estate rule. So What it's going to require, beginning December 1, 2025, is that all residential real estate transactions where the purchaser is something other than an individual, there is going to be the requirement of a report unless the transaction is exempt. FinCEN doesn't care about transactions where an individual is the buyer, because in that case, we know who the individual is. If there's a concern about money laundering, FinCEN knows who to talk to. FinCEN also doesn't care about transactions where there is a mortgage loan involved. Where there is a mortgage loan involved that's made by a traditional bank or mortgage lender, that bank or mortgage lender has an obligation to do its own due diligence on the transaction and report suspicious activities to FinCEN. So they sort of act like an outsourced umpire or referee in those sorts of transactions where there is a financing. The real estate rule is going to focus on and require reports be submitted on transactions of residential real estate that are non-financed, which means there's no loan from a traditional bank or mortgage lender, and where the buyer or transferee is anything other than an individual. So if it's a LLC, limited partnership, corporation, even a trust, in any of those cases, if it's a non-financed residential real estate transaction, the closing attorney or title agent, as determined to be the reporting person, that individual is going to need to file a report with FinCEN that identifies the transaction, identifies the transferee entity, and also identifies the beneficial owners. And that is how FinCEN is hoping to clamp down on money laundering through the residential real estate rule. I hope this explanation has been helpful. My name is Jonathan Wilson. If you want more information, you can get it through my book, FinCEN Residential Real Estate Reporting. It's available at Amazon.com. Please also check out our website at FinCENReport.com. That's where we talk about the services we provide, including our service at RREReport.com, which is an online service for evaluating transactions under the rule and then filing reports with FinCEN when they are needed. If you are a residential real estate lawyer or title agent, you need to be getting ready now for the December 1 implementation date, and we are available to help you. So reach out to us at info@FinCENReport.com for more information. Thank you for listening, and we look forward to talking with you soon.